Welcome, listener. We're doing a deep dive today into something that sounds really straightforward. The No Tax on Tips Act of 2025. I mean, no tax on tips sounds great, right? Like a clear win for everyone.
It does sound great.
But as we're going to find out, it's a lot more complicated than that.
Exactly. That popular name, the branding, it really hides what's actually a temporary law, part of that bigger legislative package. And it's got some surprising twists, even some risks.
Okay.
So our mission here is just to unpack it all, give you the full picture.
All right, let's jump right in. What does this act actually do? Because it's not like tips are suddenly tax-free across the board. What's the mechanism?
That's the key thing to grasp first. It creates a federal income tax deduction for qualified tips.
Okay, a deduction.
Yes, up to $25,000 per year. And it's temporary just for tax years 2025 through 2028.
And it's above the line. What does that mean practically?
Right, above the line. That's really significant because it directly lowers your adjusted gross income, your AGI. And that AGI number is like the foundation for so much else in your taxes, your overall liability, eligibility for credits. So being above the line means more people can access it, even if they don't itemize deductions.
Right. You just take the standard deduction, you can still potentially get this.
Exactly.
So, okay, it's a deduction, not a complete exemption. And the phrase no tax, that definitely doesn't mean all taxes are gone, does it? My sources are pretty clear on that.
No, not at all. That's a crucial point. This deduction, it does not reduce FICA taxes.
So Social Security and Medicare is still fully taxed?
Correct. For both the employee and the employer. And then you've got state and local income taxes. Those aren't affected either unless, a specific state decides to pass its own law to match the federal change.
Gotcha. So a big chunk of that tip income is still getting taxed one way or another.
Definitely.
Now, here's the part I found really surprising, almost counterintuitive. This law could actually end up hurting some low-income workers. How on earth does that happen?
Yeah, it's a really critical nuance and maybe an unintended consequence. See, by lowering that adjusted gross income...
Which sounds like a good thing.
Right. Usually it is. But in this case, lowering the AGI can reduce or sometimes even completely wipe out eligibility for really important refundable tax credits.
Like the Earned Income Tax Credit.
Exactly. The EITC is the big one. That's specifically designed to help low to moderate income working families. So for some folks, the amount they lose from the EITC could actually be more than the tax they save from the tip deduction.
Wow. So they could end up with a smaller total refund.
It's possible, yes, a net decrease. It kind of points to the idea that this deduction might primarily benefit more middle-income tipped workers, maybe not the very lowest earners it seems designed to help.
That is a really significant potential downside.
Yeah.
Okay, so let's get specific. What exactly counts as a qualified tip for this deduction, and who's eligible?
Sure. Qualified cash tips, it's actually defined pretty broadly. It covers physical cash, bills and coins, but also tips added onto credit or debit card slips, tips via check, even tips through digital apps like Venmo or Cash App if they're designated as tips.
Okay, so pretty comprehensive. What's not included?
Well, non-cash tips are out. So like if a customer gives you a gift basket or tickets to something.
Makes sense.
And importantly, mandatory service charges. If the restaurant automatically adds 20% for a large party, that's usually treated as regular wages, not a tip for this purpose.
Got it. And who qualifies? Which jobs?
It's for workers in traditionally and customarily tipped occupations. The Treasury Department is supposed to release a definitive list soon.
So servers, bartenders, delivery drivers.
Presumably, yes, those sorts of roles. But the law explicitly excludes certain professional fields. Think health professionals, lawyers, accountants, tips they might receive wouldn't qualify for this deduction.
Interesting distinction. Okay, shifting gears a bit. What about the businesses, the employers? What changes for them? Any new responsibilities? Or maybe benefits?
Oh, absolutely. There are changes on the employer side, too. A big one is a new reporting requirement. Employers now have to separately identify and report these qualified tips on the employee's Form W-2.
Ah, so the IRS can see exactly what's being reported as qualifying tips.
Precisely. It serves as a new enforcement tool for the IRS, basically. They can easily cross-check what the employee claims as a deduction against what the employer reported.
Makes sense. What about tax withholding?
For the first year, 2025, the federal income tax withholding rules stay the same. But they expect new withholding tables to come out for 2026 and beyond to account for the deduction.
Okay. And any benefits for employers in this?
Yes, actually, a pretty significant one, and this part is permanent, unlike the deduction itself.
Oh,
The employer FICA tip credit, Section 45B, which lets businesses claim a credit for the employer-paid portion of FICA taxes on tips, that's now been expanded
expanded to who?
to include beauty service establishments. So think barbershops, hair salons, nail salons, estheticians, spas. Those kinds of businesses can now claim this valuable credit. That's a big deal for that specific industry.
That is a significant expansion. Okay, so new rules, new reporting, that always raises the question of audits. What are the main audit risks here for both employees and employers?
Yeah, audit risk is definitely something to be aware of. For employees, the absolute key is meticulous record keeping.
Like a daily tip log.
Exactly. A detailed daily log is going to be vital to back up any deduction claims if the IRS asks questions. Without proof, that deduction could be denied.
Okay, and for employers?
For employers, the IRS is going to be watching closely for any attempts to, let's say, mischaracterize regular wages as tips to try and help employees maximize the deduction. That's a major red flag for them.
Trying to game the system.
Right. And that new W-2 reporting we mentioned, it gives the IRS a really easy way to spot discrepancies between what the employer reports and what the employee claims. So non-compliance risk definitely goes up for both sides.
So, bringing it all together then, what's the key takeaway for you, the listener, after this deep dive?
Well, I think the main thing is that this No Tax on Tips Act, despite the catchy name, is actually a pretty complex piece of temporary law. It's got some clear benefits for certain workers and now beauty businesses too. But it also carries hidden risks, especially as we discussed for some lower income workers due to the interaction with credits like the EITC. It's not a simple win-win.
Right. It's much more nuanced.
Definitely. So maybe the provocative thought to leave you with is this. Considering this law is temporary, set to expire after 2028, and has such a mixed impact, how might it actually shape the future of pay in the service industry? What happens after it expires? And maybe what strategic financial planning should you be thinking about now before we hit 2029?